Janet Yellen, your bull market queen, is she the one driving record highs in equities?
Well, I've noticed that she is withdrawing the Punchbowl slowly, and Mario Draghi is doing the same thing at some point. You're doing the same thing in London. You're doing the same thing in Japan with Kuroda. So monetary policy, which was really helpful, Tom, in 2009, is now coming back. And you've got to take money out, you've got to raise rates and get more normal. And then the market has to adjust to that.
Is your day-to-day methodology now, like when you were an analyst grinding through the auto industry and parts and all that, industrial America, is it the same thing that you do that you would do with Graham Dodd and Cottle or with Roger Murray? Is it the same methodology?
Yeah, nothing has changed. In other words, the question is, if you're a CFA, chartered financial analyst, what do you do? Is it worthwhile to pursue that, Tom? The answer is you gather the data, rate the data, project it, interpret it, communicate it. And from my point of view,
right,
you learn how businesses work. For example, yesterday we sat down with Yakult, a Japanese company that we happen to own 1.2 million shares of. The stock's gone from. They sell a product like this called probiotic. Okay, this is a.
I've never had it. It's healthy.
Stop. Don't change your habits.
Okay.
The point is, this company has done extraordinarily well. Has taken what they did in Japan and gone global. And so we talk to them, we visit with them, we have an office in Tokyo. So we're actively looking and culling through. Why did we look at it at the beginning? Was organic, natural, and that's why we owned a Danone, why we owned a White Wave.
We just talked with Scott Teal of BlackRock, and the idea here, the rage now is smart beta. I call it dumb alpha. I can't figure it out. What do all these newfangled things mean to you? When you hear smart beta, what does Mario Gabelli say?
Well, you know, I happen to go back to 1893, 1873, 1929. You know, we always have some new ideas in the market. Tom, think about the fact that in 1969-70, you had an economic contraction, 71-2. The banks came up with the notion of the Nifty 50. Buy a growth stock, hold it forever. And so you go through these cycles of different fashions. And, you know, in 1841, somebody wrote a book on the illusions of grandeur. But buying a basket of stocks today, over the next 20 or 30 years, what are you going to earn? If you took the data that was available from Ipsen, an academic study from 1928, if you owned an S&P index, you probably made 5.5%. And I think over the next 10 years, you'll make 6 or 7 or 8%. With inflation starting to rise, earnings okay. And owning an index fund is not bad.